quiz too. That's all right. So we'll have a quiz again, and then on Friday before we leave for the holiday, is that what it is? The review for the test? I don't know how this works. Makes it less. The quiz is Monday after the holiday.
Yeah.
Okay, so Wednesday is the review for the quiz. I didn't do one on Friday because everybody be gone for the break. I know that's going to go. So anyway, Wednesday we'll do the review for the quiz, even though we will start chapter 9 next time, and we'll be finishing up chapter 9 after that. But still, we'll do that. So plan on that. And then Monday when we get back, we have a quiz. That's what the deal is. And then we're going to have a study session for the test Monday night, and then we're doing the test Wednesday. So obviously what you need to do is get yourself in a position to do well on the quiz and therefore on the test over the holiday. So it's not really a holiday, right? You guys can figure that out now. You've been here long enough that you know these breaks are really for study. Right? And if you use them to study, you do really well in your classes. If you don't use them to study, you don't. That's basically it. Take the time, guys. Do it. Yeah, anyway, and then notice it says on the schedule there, March 9th, we're taking the test, and the last day to drop with the W is March 16th. And, you know, if you have done all the quizzes and tests or whatever, the vast majority, you've done the test at least, up to that point, I will give you a W withdrawal if you need to have one. So you concentrate in other classes, or you're just buried in here, or whatever. So there's a few people that applies to, only a few. So anyway, but I think if I was in a C range, C minus range or something, I certainly would stick with the class and just go for it. I have lots of people who prove as the course goes along. And I have lots of people dramatically improve every year. Okay, so I study it, get it down. All right, you just take one thinking, you know, all of us or something. It takes you a while. So, you know, if your quizzes didn't look very good, your tests look better, that's a good sign, right? That the final could really fall in place for you. All the finals can be very predictable. Have you noticed the tests are very similar to the quizzes? Mm-hmm. Yeah. So it's good to get ready for the quizzes and the tests are different. Right? And then the final is going to be basically 2/3 of the questions from the test. All the numbers change, the names change, things like that. Okay. So if you didn't know how to do something on a quiz, we can talk about this over and over. If you don't know how to do something for a quiz, what do you do? Get it down to the test. If you don't know how to do it for the test, what do you do? Get it down to the final. When's the best time to have it down? Well, I think the best time to have it down is for the quiz. Quiz. Second best time? Test. The third best time? Probably on the final. Yeah. Okay. So, yeah, sure. It'll work out. But you can dramatically improve your position as you go along here. So, anyway, don't let up. So, anyway, maybe what we'll do is do some stuff from property, plant, and equipment, huh? We've done depreciation already, haven't we? So they're just layering a little bit more on. They're going to be different methods of depreciation. So let's go through the methods today that I'd like you to know. Okay, so I think that we already know how to do what? Straight line? So one of them is straight line depreciation. So we got straight line. You guys agree? Okay, so we'll do that method. Okay, another one is what? Declining balance is one. Okay, so we got declining balance methods, and they say double declining balance, which is 200% declining balance, but you could also do 150, which is 150%, what's the percent straight line? Okay, doubles 200%. You do 125, you do 175. So we'll get into those. All right, what else do we have? Units of production. This is kind of like straight line, but it's spread across the units you're going to produce instead of so much per year. Straight line is just so much per year, right? Okay, units of production. What else we got? That's all you offer, but I like to have you have fun than that. So we're going to do some of the year's digits. It's an old tax method that some companies still use. Just give you an idea that there are a variety of ways people can do depreciation. It's not too bad. Okay? So,
What does it say?
some of the year's digits. Some of the year's digits. Okay? Some of the year's digits. All right. So anyway, so why don't we buy an asset and then do these different methods, huh? Okay? Let's say that we buy a building, units production. Let's do a piece of equipment. Okay? Let's say it's a machine. Okay? So I'm buying a piece of machinery, and I buy it for $130,000. Okay? And let's say I pay 10% down. What if I gave you that? You've seen this before, huh? Okay, what do we get? Buy something for $150,000, 10% down. The rest, I guess, I could probably sign a note for. And I just could trust me, probably. Okay, but it's a big accounts payable. So let's say we sign a note for it. What would be your journal entry for that, no matter which one it is, depreciation methods you use?
So you bought equipment?
Yeah, machine.
You said it 138,000 for equipment.
Yeah, just debit equipment. Whatever you're going to call it, machinery, equipment, building, whatever the thing happens to be, for $130,000. Okay. And then what?
You credit cash for 13,000.
What? Okay. And then what else would you do?
And then you do a note for the rest. It's like 117.
117. Okay. Yeah. You guys know how to do this. Right? So what I'm going to do at the end of every year, let's make this be January 1st, and let's make every year end be December 31st, so we don't have part year depreciation. By the way, if you have part year depreciation, it's no big deal. Just figure out what it is for the year. If it's for half a year, divide it in half. If it's for a quarter of a year, take 1/4 of it. If it's for 1 month, take 1/12 of it. Big deal. Right? Okay, so you can calculate what it is for a year and then convert it. So if I ask you to do that, so what? Right? There's some problems where the author does that. It's fine. Okay. So what are we going to do at the end of each year? Let's assume we're not doing monthly financial statements or quarterly. If we were, we'd have to do every month, right? Every quarter. But if we only do annual, what are we going to do at December 31st? We already know this stuff. We've been using straight line depreciation. Yeah, but what? Depreciation expense. And credit what? Accumulated depreciation. Now this is going to be kind of like what we did when we were messing with inventory and we came up with 6 different inventory values, 6 different costs of goods sold. Guess what? Each one of these depreciation methods is going to give me different depreciation expense for each year. It's the whole deal. Okay? So what we're trying to do is get a good estimate of how much we used up each year. That's it with each of these methods. Okay? Now there's also a tax method, right? Called Modified Accelerated Cost Recovery System, MACRS. Kind of funny, it's modified system. Okay, Modified Accelerated Cost Recovery System. It's kind of interesting. It's modified because the original one was only in effect for a couple of years, and then they modified it. But ever since, we call it modified. That's what it is. That's what the law says. It's tax law. This allows you to depreciate assets really, really fast. Like automobiles last 3 years. Did you know that? Of course they last longer than that. Trucks last 3 years. Of course they last longer than that. Some buildings only last 15 years. Right? Some last 20 years. And of course they last longer than that. Why would you be allowed to write them off really fast? Oh, by the way, they're not straight line either. They're typically double declining balance. Accelerated methods, right? Okay. Why would you be able to use a really short life and then double it up too? What are they doing? Reduces taxes. It allows people to reduce taxes. So this, by the way, when we talk about tax loopholes, it's hard to tell a loophole from an incentive because they're kind of the same thing. Right? Does this reduce people's taxes? Yes. So is it a loophole? Yes. Right? If you happen to buy these assets, you have lower taxes. You do. Why would the Congress decide to do that? You think they just did it for people they like? Maybe there's some of that. Probably not much. What is it really? I feel like business more than people or something is silly. Businesses don't even exist. It's just people own them, people run them, people work there, people buy their stuff, people sell things to them, right? So liking business better than people is an absurd concept because businesses don't really exist. We created them, right? People exist. that do?
Stimulates the economy.
Stimulates the economy. Yeah, it might not be good for the environment because it encourages people to buy equipment and then get rid of it before they used it up. But some people would argue, well, really doesn't even hurt the environment for the most part. Because then what happens is, let's say, young brands or UPS, right, buy all kinds of new equipment. UPS is buying new airplanes and new trucks and so on, right? Young brands are buying all kinds of stuff, right? They use it up for tax purposes really quickly. And if they want to keep getting a tax break, what do they have to do? Buy more new stuff. So they're motivated to buy more new. What would you rather do? Would you rather drive a new car or use new, of course? What would these companies rather do, seeing as they're delivering? UPS is delivering stuff. What do they want? New equipment or old? They'd rather have new. But they have more incentive also to have the new because of the tax law. So what they do is they sell their equipment, right? And who do they sell it to? Basically smaller businesses. They can't afford the new stuff, right? They're not making enough money to need the tax break anyway, really, right? Early in their lives, or if it's a small company. Then what happens? Then what happens? That generates more economic activity, right? Of course, we're producing more goods, right? Which produces jobs. Some people would say, well, those jobs used to be in the U.S. and now lots of them are overseas, which is true. But we still manufacture a lot of stuff in the same amazing amount, right? So is it true we've lost manufacturing jobs? Yes, some of it is moving the jobs overseas. It's true, right? To China, no, not even overseas, Mexico, right? Not a lot of it, okay? But we've still grown the economy, right? Okay, so, and by the way, is it just moving jobs away, or is it technology eliminating jobs? If you use robots to produce an automobile, you use less labor. Yeah. Okay, so if we automate more and more and more, guess what? There are fewer and fewer manufacturing jobs. Okay? So, there are all sorts of issues with it. But anyway, what's the deal with this? Why do they have this modified accelerated cost recovery system? Save people tax dollars, but you generate economic activity. Both. Just both. Okay? So, of course, then people would use it. They're motivated to use it, right? Because it saves tax dollars. And that generates a lot of economic activity. It just does. Okay? For good or for bad. Okay? A little both, probably. Okay, anyway. But that's for tax. And it's really important to note. We would never use that on financial statements. Why not? Because the lives are unrealistically short and it's accelerated. What we do is we use one of these methods, these types of methods, okay? We use one of these and we pick the one that we think best reflects how we actually use our assets when we use them up. When would straight line make sense? Maybe for a building. I don't know. Maybe for a building. Do you use up about the same amount this building did? Do you use up about the same amount each year? Yeah, maybe. It probably makes sense. Okay? But how about an automobile? You use the same amount of the automobile every year? Actually, what happens when it's brand new? Very little maintenance, right? Very few problems with it, right? What's happening? You're using up a lot of it in the early years, aren't you? And I don't just mean value, economic value, market value. I don't just mean that, but it's utility value. This is talking about utility value. I'm using it up, right? What happens after the car has 50,000 miles? Start replacing things. The maintenance becomes more expensive. Right? It's not breaking down yet, but you're starting to spend more money on maintenance, right? And it's not as productive an asset, probably. Okay? Same with the truck, huh? What happens when it's 100,000 miles? It's more and more and more. My wife has a Volvo that now has 151,000 on it. I'm so proud of her. I'm more proud of myself because she didn't buy a car for 40,000 miles this time. Way too expensive. Ridiculous, right? So, but, what's starting to happen with it? It's starting to break down. Yeah, there's something wrong, and there's something else wrong, and there's something else wrong. And each one of the things so far has been less than a car payment on a new one, so what happens? It just take care of it, right? It's more expensive than to buy houses or rent houses. But you get to own it, right? Okay, that's all right. It's fine. You can do what you want with the thing. But you still have to pay for everything. Okay, so in any event. So what we're going to do is we are going to pick the method that we think best uses up the asset. So maybe for an automobile, I use some declining balance method because I get more depreciation in the early years and less in the later years. By the way, you're going to have the same amount of depreciation with all the methods. Because you bought an asset, right? And as you use it up, it's gone. And when you're done using it up, there's no more to use up. That's it. It's no big deal, okay? So it's going to be pretty simple. Now, you guys know what a salvage value or residual value is already too, don't you? So we would need to establish a salvage value for this thing, okay? So what I'd say is, look, so this is what I'm doing. I'm calculating needs, right? No matter what. So what I need is a salvage value or a residual value. Let's pick one. How much do you think it's going to be worth at the end? How about, I don't know, how about $10,000? Or should I do more? Yeah, maybe. Let's make it 30,000. Might be more interesting. Let's make it 30,000. Okay. What does that mean? My salvage value or residual value is 30,000. I am going to sell it at the end of its life for 30,000. I take out my crystal ball and guess how much I'm going to sell it for, right? Okay, I don't know. What if I sell it for more than 30,000? That'll be a gain at that time. What if I sell it for less? I'll have a loss at that time. And we'll learn how to handle that too. It's not a big deal. Okay? All right. So what would I say? I'd say my cost is 130. My salvage or residual value is 30. Residual is what's left over, salvage the way we salvage it for. Okay? My depreciable value, we call this depreciable value, is 100. As soon as I have accumulated depreciation of 100 with any of these methods, what am I going to do? Stop depreciating, and it'll be on the books at net 30. Because I'll have the equipment that cost me 130, and I'll have accumulated depreciation how much? 100, right? It'll leave a book value of 30 until I get rid of the asset. What if I keep using it? I guess it's free, right? Really, I screwed up my estimate how long it was going to last. But what do you do with changes in estimates of your account? Nothing, right? In the current year and prospectively in the future, so we don't go back and restate the prior years, okay? And we'll learn how to do that too. Take a look at that. Okay, so there's a few things to do here. So let's try the different methods. Oh, what else do I need? I can give you something else. What do we need? We'll start with 200% declining balance. What else do I need to know? Yeah. Yeah, number of years or number of units, right? Okay. So let's say that we think, what life should we pick? Maybe 5 years? Let's do 5 years. So it's either going to last for 5 years, and both of these would be 5 years. Declining balance would still be 5 years. Or we're going to use up so much of the asset in terms of its productive capability over its life. Okay, so let's say this is a truck, okay, and instead of using years, we're going to use miles. And let's say we think the truck is going to last for, I don't know, 250,000 miles. We are going to use it for 250,000 miles. Okay? And we spent 130,000 for it. We're going to drive it 250,000 miles. Okay? And so our units would be what? 250,000 miles. So what are we going to do? Every time I drive a mile, I'll depreciate some. How much do you depreciate? Not a lot per mile, huh? Right? It's a real deal. 100,000, get 250,000 miles out of it. It's ridiculous. Get a $400,000 truck, probably. Get that many miles out of it. Tractor trailer big. Okay, but anyway. So what would you do? I take probably the 100,000 I'm going to depreciate, divide it by the 250. Makes sense? So much per month. What would I do for the years? I guess I take the 200,000 divided by 5. It's just too easy. Okay? And then the declining balance, we'll get to that. Okay? Some of the year's digits is going to be really interesting too. It's a strange method. But it's sort of it is an accelerated method too. So we'll give that a shot. So let's do this. Let's take it. All right, let's try a straight line. Let's do the easy one first. Okay, what would you do, guys? You already know how to do this. Cost of the asset was how much? salvage value or residual value is how much?
30.
How much are we going to depreciate? 100,000. How many years are we doing?
5.
What does that give you per year? 20 grand, right? Everybody agree? Year one. Let's do year one. Do the journal entries for year one. Which I hope I give you these. I probably will too. Might have some things that are real easy for you. Right? Why not? Let's do the journal entries for each one. What are you going to do at the end of each year? Debit what?
Depreciation.
Depreciation expense. And credit what?
Accumulated depreciation.
Is it going to be exactly the same journal entry in terms of the accounts no matter which method we use? Yes. It's always going to be debit depreciation expense credit accumulated depreciation. Right, guys? Very good. Just like on the allowance for doubtful accounts thing, it was always debit, bad debt expense, credit allowance, wasn't it? You're just calculating different amounts. A number of people gave me a whole bunch of different accounts. Didn't I say it's always the same one? I did, right? And people's brains fried and they started doing all kinds of weird things. Okay? All right, so this is always going to be the same every single year. And you know what? It's going to be the same journal entry every year too, seeing if it's a full year. What's it going to be, guys? Debit depreciation expense, how much? 20,000. Credit accumulated depreciation. Oh man, is that simple? Yes, that's it. There's just nothing to it. Oh, by the way, what if I buy it mid-year? I buy it June 30th. I guess it'll only be 10 the first year. And then I do what? 4 years of 20, and then what would I have to do in the 6th year? Half a year, 10. Everybody got it? Just like that. Okay, so tell me what the remaining book value is each year, the net asset each year, at the end of each year. Let's see. I have equipment with how much in it? It's 130, right guys? 130. What will be an accumulated depreciation at the end of the first year? You debit depreciation expense, you credit accumulated depreciation. What will be in there? 20. What's the remaining book value? 110. Could you do that for me? Big deal. All right. Okay, so 110, I guess, at that point. What will we do the second year? Oh, by the way, then what do you do with depreciation expense at the end of the year? Close it, right? You close it and it's now 0, and then you start over. It's going to be 20 every year, isn't it? Okay? Well, what do you do with accumulated depreciation, seeing it's a contra asset at the end of the year? Nothing. You just keep it, don't you? Keep on going. Right, guys? Okay, so then we do exactly the same thing year 2. Now what will happen? Debit depreciation expense, credit accumulated depreciation. What do you got in there? 40. What's the remaining book value? 90. Let's do the third year. Debit depreciation. Oh, you closed depreciation expense, right? So retained earnings again. Everybody got it? Debit depreciation expense, credit accumulated depreciation. What's your balance in accumulated depreciation at the end of the third year? 60. What is the remaining book value? What's the book value of the thing right now? 130 less 60 is 70. Okay, and then we close the retained earnings, right? Do it again, right? 80. Now 50, right? Do it the 5th year. What do we have? It's going to be in here. 100. Everybody got it? And of course you close depreciation expense to retained earnings. Anyway, what are you going to do in the 6th year? If you still have the asset? Nothing. You're going to leave it there at 30 until what? You sell it. That's it. Okay? Unless you change the estimate of its life, which you can do. We'll do that later. Okay? All right? So that's it. That's the whole story, huh? You already knew how to do this, huh? So what's going to be new here? We're going to do it for these different methods. That's all. Another way of calculating. Okay. Now, here's something to think about. The only one where you're not going to just depreciate the 100,000 depreciable value, the only one where you don't just depreciate the depreciable value over the time is declining balance. We're going to do things differently with declining balance. When they say 200%, they mean, listen to this carefully, they mean 200% of the percentage straight line would have been. It's really more than straight line would be. Okay? That's the trick to get that. Okay? And then it's going to make sense. Don't just double straight line depreciation. Okay? It's really going to be more than that because it's double the percentage straight line is, and we're going to take it times the full carrying value of the asset, okay? So let's give this a shot. First, let's do units of production, because units of production is so similar to straight line. It's kind of just straight line over the units that we're producing, okay? So what was the cost of the asset again, guys? 130, right? What's the salvage value or residual value? 30, we decided. What's the depreciable value? 100. And what I want to do is I want to spread that 100 depreciable value over what? The units I'm going to produce, which I said are 250,000 miles for a $100,000 vehicle. That's pretty good. Okay, so that's the life now is the way to look at it, is 250,000 miles. What is that? How much are we going to depreciate per mile, huh? How much is that, guys? What's 100,000 divided by 250,000? How much is it? 40 cents. Yeah, good. 40 cents per mile, $0.4, right? Every time I drive this truck a mile, I'm going to depreciate it 40 cents. Got it? Although what I'll do, of course, is figure out how much I drove it for a year. You guys know how to tell how much you drive your vehicle for a year? You know, you can read the odometer at the beginning of the year and read it at the end, and differences which you use. If it's forklifts, it'd be hours, right? There's an example where we use units of production. A forklift, it does not matter how much you drive it around. It matters how much you lift and lower, right? That's what wears out on a forklift, not driving it around. You don't drive it very far anyway, typically, right? Okay? It's lifting that really puts strain on it, okay? It's going to wear out. So you use it for hours. So they don't have odometers on them. They have clocks on them. How much time? So you look at how much you used it, and then you depreciate it over its useful life. Got it? It's only going to go so many hours on average, okay? All right, so good. So anyway, every time we go a mile, we'll depreciate 40 cents. So let's say it's this, okay? Let's say year one, here's my usage, okay? Miles, in this case miles. It could be units I'm producing of some kind, right? Product, Barbie dolls, right? We make them, okay? And the machine's making Barbie dolls. Got the idea? So how many can I make with the machine before I wear the machine? So it could be anything, okay? All right, so let's say that the first year I use 60,000 miles, okay? 60,000, got it? Year two, I also use 60,000. Year three, I happen to use 70,000.
Are you doing units of production? Are you doing
Units of production.
Oh,
46. This is my actual miles. Okay? I guess I'm going to use 250,000 miles. I don't know. Right? But over the first 250,000 miles, what am I going to do? Depreciate the whole 100,000 at 40 cents a mile. So let's say we did 60, 60, and 70, and then in year four, the thing's starting to get old. What am I up to? 142.10. Okay, so I use, in year four, I use 50. And then in year five, it's a 5-year life, I only use 40. Okay? Let's say that's the case. Tell me what the depreciation expense would be. And this is going to be the debit, the depreciation expense we're coming up with here, right? And then we'll credit accumulated depreciation at the same amount. So what do you guys want to do here? Take these times what? 40 cents. That's all there is to it. Okay, 40 cents, all the way down. Everybody got the idea? 40 cents. Okay, so the first one is going to be what? Depreciation expense is going to be how much? This will be the debit depreciation expense, okay? And then we'll figure out how much accumulated depreciation we have. And then we can figure out what our remaining book value is. Okay? Sound good? Same thing we do with straight line. So what's the first year going to be? That's 24 grand, right? Debit what? Depreciation expense. Credit what? Accumulated depreciation. What's my remaining book value? Now be careful. Don't take 100 less 24, right? What's my equipment recorded at? My equipment is 130, right? Okay, so if your equipment's 130 and your depreciation, accumulated depreciation is 24, what's the remaining book value, guys? 106. $106,000. Everybody good? It's simple. And when do I want to stop depreciating? When my book value gets down to 30. No, Not zero, 30, right? So it's 130, and I'm going to depreciate 100 of it. Okay, good. So, all right, what's the second one? Same, right? 60 times 40 cents happen to be the same. Debit depreciation expense, credit accumulated depreciation. What would be my balance of accumulated depreciation now?
40.
And remember, each time we do this, we're closing depreciation expense for retained earnings. Right? Yeah. So what's my book value now? It's 130 less 48. How much is that, everybody? 82's left? Okay, good. Not down to 30 yet, am I? What would be the third year? 70,040 cents. 28. Debit depreciation expense, credit accumulated depreciation. What's my new accumulated depreciation? I had 48, whoops, 48 plus 28.
76.
Right? It's 24 from the first year. Like this, you guys. Equipment has 130 in it. Right? Accumulated depreciation, what have we been doing? We put in 24 the first year. We put in 24 the second year. That made it 48. We put in 28 the next year. What does that make it? How much? 76. All right. 76,000. Everybody agree? What's the remaining book value? 130 less 76. How much is that? 54,000. Now, when do we want to stop, gang? When we get down to 30 remaining book value, right? Okay, so 50,000 times 40 cents the next year, how much is that? That's 20, isn't it? Debit, depreciation expense, credit accumulated depreciation. And I've got another 20 in here now. So now what do I have? 96. How much is left, everybody? 34,000. Now we're getting close. What do we have to do in year 5? The most we can depreciate is how much? 4,000. That's it. Big deal. Okay? So even though I have 40, 40 would have been how much? 40 times 40 cents would have been 16,000. I can't use that much, can I? What's the max I can do? 4,000 more. Debit depreciation expense, credit accumulated depreciation. And how much do you have in accumulated depreciation? 100,000. And here we go. Right? So what's my remaining book value? A number of you, this class is really easy, isn't it? Because you're concentrating, you're reading, then you're concentrating. You're listening when you come in here. I can see recognition on some of your faces like, oh, now I got it. Now I got it. I mean, you got it. Now you study a bit, right? And you nail it on the quiz. That's how this is working, isn't it? You do that in everything. But you got to decide you want to do it. Decide you want to do it. And you know what? All these classes that you're doing only go for 16 weeks. Then you do something else. You guys can hang in there for 16 weeks, right? In the classes you got. Keep going, keep going, keep going. I used to teach in a quarter system. I liked it far better. It was 10 weeks. You know how you guys can't stand me after 5 weeks? Through all your professors, I hate the class. I don't want to go. Well, in the quarter system, you're halfway done, so then you suck it up for the final, right? This is rough in semester system because you go about 5 weeks, and then you do nothing for 5 weeks, and then you work really hard for 5 weeks. So you work 10 out of the 15 weeks. Am I right? It's kind of true. The middle is just dead, right? I wish I was anywhere else. Quarter system works much better. You know why they don't do the quarter system? Because it costs more. Because we have to register you 3 times a year instead of 2. That's why. And do finals and grades and everything. I think quarter system's far better. What do you guys think? 10 weeks, it's over. Have a vacation. Oh, by the way, then when you do your spring break, you can have a real break. Because there's no vacation for 10 weeks. And then there's a vacation. And then no vacation for 10 weeks. And then vacation. Works so much better. You guys should lobby for that for your children. Right? Let's go back there. It's great. On the West Coast, it's all quarters. Still. Most of it. On the East Coast, most of the country, Midwest and East Coast, it's all semesters. So far better model. Actually, what I think we should do is do 4 years. You have summer too, and they could all be 10 weeks. 40 weeks a year in school, 12 weeks off. Still be okay, wouldn't it? No. I don't know why it's like that. So I have recommended development. I thought it would be a really nice model to attract students. If you could go year round and still summer off, so got more than that. Okay, anyway, that's all the deal, you guys. This is nothing, huh? By the way, what if I sold it at the end of the third year for $50,000? What do you think would happen to me? Let's try this. Do something else here. If I sold it at the end of the third year, what's on my books at the end of the third year? Let's see, 130,000 equipment, right? And how much accumulated depreciation? 76. And what'd you say the book value is? 54. Absolutely. If I sell it for 50, what just happened to me? You have a loss. Okay, let's report it. Let's do that. This is not hard. I sold it for cash. What do I get if I sold it for 50? Cash. Debit what? Cash for 50. Everybody agree to that? What don't I have anymore? They went away with a piece of equipment. What's on the books for my piece of equipment? It is 54,000, but it's in two different accounts. One is what? Equipment, right? If I don't have the equipment anymore, what should I do to equipment? Credit. That's simple. 130. But you said the book value is only 54 though. Why? Because we have accumulated depreciation here after 3 years of how much? 76. Don't you need to get rid of the accumulated depreciation if you get rid of the asset? Of course you do. So now what I've got is a $54,000 asset that I sold for 50, and what do I need? Another debit, right? 4,000 of what? Loss on sale. There's your first loss, gang. Right? Loss on sale. I sold it for a loss. Got it? Where are you going to put that loss? Income statement under non-operating, right? Sales less cost of goods sold is gross profit less all your operating expenses gives you operating income. There's non-operating things that are either unusual or infrequent. If they're both unusual or infrequent, they're extraordinary, aren't they? Right? About that? Okay. If it's one or the other, not both, like this, right? You're not in business to sell this asset. Your UPS, you bought this truck. Yeah, right. 100,000, 250,000 miles. But anyway, you bought this truck, right? You drove it for 200, or well, you didn't go for the whole 250, but you drove it as long as you wanted to use it, I guess, and now you get rid of it. You're not in business buying and selling trucks. You're in business delivering stuff, right? If I'm Ford and I sell a truck, that's going to be sales and cost of goods sold and gross profit. Got the idea? If I'm UPS and I sell a truck, that's peripheral to my business, we call it, non-operating. Okay? Everybody got the idea? Well, that's selling it for 50. Let's sell it for 60. What would that look like, you guys? Debit cash for 60. Credit what? Equipment for 130. This is too easy. What else do you need to get rid of? You better get rid of the accumulated depreciation or you have a negative asset, right? You know, you credit the asset for 130, it's gone. You can't have accumulated depreciation on it. And that's 76 still, right? Okay, what happened to me this time? I need a credit of how much? 6,000, is it? 54 book value. Yeah, you got 60. What do you want to call this one? Okay. By the way, does it make sense a loss would be a debit, seeing as reducing income on your income statement? And a gain on sale would be a credit? Why would that be? It's increasing income, of course. What if I sell it for exactly 54,000? No gain, no loss. Debit cash, 54,000. Credit equipment. Whoops. 130,000. Debit accumulated depreciation, 76. Do I have a gain or a loss? Of course not. Not if it's sold for book value. Everybody got it? This is easy, isn't it? Okay. So then, let's do, this one's kind of fun. Let's do some of the years digits, okay? Some of the years digits. What you do is just this. You still have the cost of 130. You still have a salvage value of 30. And then we've got depreciable value of 100. Okay? And what we do is we flip the years upside down. Okay, this is some of the years. Okay? I'm sum of the year's digits for years 1, 2, 3, 4, 5. I reverse the years. No kidding. This one is going to be 5. This one is going to be 4. This one is going to be 3. This one is going to be 2. And this one's going to be 1. See, I just reversed the order of the numbers. Flip them upside down. Then I add them all up. What's 5 plus 4 plus 3 plus 2 plus 1? How much? 15. Is that what it is? What I'm going to do is I'm going to depreciate 15/15ths of it. That's it. So the first year I'm going to do 5/15ths. I'll do a third. The second year I'm going to do 4/15ths. Third year I'm going to do 3/15ths. Fourth year I'm doing 2/15ths. And the fifth year I'm doing 1/15th. Little reward for coming to class, you guys. At least watching videos, maybe. Right? Okay. Not in the book, but it's no big deal, is it? Now what do you want to do? I'm doing 15/15ths of something. Do you want to depreciate the 100 or the 130? You better do the 100 so you don't depreciate the 30 salvage value, right? That's it. So take it times 100 each time. No kidding. Okay? Every single time. So what's that going to be? Now I made all the numbers weird. I'm sorry. Not weird, but hard for Keith to calculate. Okay, what is this one? 33,333? Everybody agree to that? What's it going to be? That's depreciation expense, isn't it? Oh! What's accumulated depreciation going to be then? Same thing. 33,333. Got it? What's the remaining book value? Be careful. You'd have to take 130 less 93,333. Right, guys? Okay, how much is that? Should have left some room. Way to go, Keith. How much is the remaining book value? 96,667. Actually, the pennies. Okay, let's do year 2. What's it going to be? 4/15ths. What's 4/15ths of 100? What is 100 divided by 15? Look at each year here. 100 divided by 15. What do you get? 6,666. 6,667. Right? Well, then what's double that for 2/15ths? 13,333. All right. What's triple 6,667? Is that 20,000? 1/5, right? 3/15ths. And then what's 4? 26. 667. So we don't really care what the numbers are, do we? They're easy. So each one of those is going to be debit depreciation expense and credit accumulated depreciation. So what will be my accumulated depreciation at the end of year 2 here? There's year 1. What is it at the end of year 2? 33 plus 26, 667. How much is that, you guys? 60,000. Okay? So this is just going, right? What's the deal? It's going to depreciate more in the early years, and then each year goes by, it's less. This is an accelerated method, isn't it? That's all. Okay? So what's that going to make my remaining book value, by the way, at the end of the second year? If you have 60,000 accumulated depreciation, 130 less 60 is 70, right? So it'd be 70,000 at the end of that year. If I asked for that, you could do it, couldn't you? Not a big deal. The next one is debit depreciation expense 20, credit accumulated depreciation 20 for the third year. What does that make accumulated depreciation? 80. What does that make the remaining book value? 80 away from 130 is 50. And then what are we going to do the next year? Debit 13,333 to depreciation expense. Credit accumulated depreciation 13,333. Now what is your accumulated depreciation? 80 plus 13,333, 93,333. Fantastic. What's your remaining book value? 130 less 93,333, isn't it? How much is that? 36,667, something like that? Gee, I wonder what's going to happen the next year. You debit depreciation expense for $6,667. You credit accumulated depreciation for the same amount. How much do you have in accumulated depreciation? It's a miracle, 100,000. What's left? 30,000, which is the salvage value. And we're happy. Everybody got it? This is easy. What if I sold it for 40,000 now? You have a gain of what? 10. What if I sold it for 25,000? You have a loss. Everybody got the idea? A 5. And remind me we need to do declining balance. I guess you guys didn't want me to take a last